You could list, JoAnne, probably 10 really good things and 10 somewhat concerning things that the markets are facing right now.
Oh, yeah, absolutely, Joe. It's a very uncertain time. You know, a quarter ago when we were waiting for earnings, we had the Omicron wave. Now we've got the Russian invasion of Ukraine. We have China's zero COVID policy, which is really a concern because it's slowing down production. It's slowing down the transport of goods. But on the positive side, we had that strong industrial production number on Friday. We have consumer strength still happening. Look at the reports on the use of credit cards. Consumers are still out there spending. And so, you know, we're still in a recovery period in the U.S. economy, and those sanctions are really, you know, more going to affect Europe. So I think we should be wary of the earnings reports and the guidance, because I think firms are going to still continue to be cautious. But when we look at the inflation numbers, we should expect some of that's going to pass through into sales, into profits. And therefore, you know, I think folks are a little bit too cautious on some of the valuations that have come down so sharply. So watch for the long-term signals that we get from companies. And some of the areas we like, not just some areas of consumer that have pulled back hard, but the long-term growth drivers like data centers, 5G. There's still a lot of good opportunities out there. It's a good time to be shopping for bargains.
Can you, Gabrielle, I'll be right with you, but just a quick answer from JoAnne. Do you think it's different this time in terms of what kind of Fed funds rate will be enough to get us to normal? It's not the way it used to be in our careers.
Absolutely right, Joe. You know, I think this time it's more complex, because think about what's going to happen as we go through this year. We have more semiconductor capacity coming online. Those factories are going to be churning out chips starting mid-year. That's going to help the auto industry. It's going to help appliances. It's going to help the home builders. And you know, even with zero COVID policy in China, we're still going to be getting some more out of them. So over the course of the year, we're going to get some supply constraints easing up. That's going to help the inflation problem, even as the high inflation and other constraints start to pull the consumer back a little bit. So it's really hard to tell how, you know, much the Fed funds rate is going to have to go up, how much that bleeds into the 10-year, which ultimately affects the long-term valuation of stocks.
And Gabriella, we've got a lockdown in Shanghai. We've got just a troubling headlines every day from Ukraine and Russia. And yet, 6 straight 50 basis point rate hikes is sort of predominating some of our discussion today. Do you think we'll get those? And how do you think the markets would react to that?
We don't think we'll get quite as many 50 basis point rate hikes in a row as Bullard suggested yesterday. I think he's speaking more from his personal opinion. What I think is a broader read-through from the committee is they would like to start getting closer to neutral, and that seems like really a realistic expectation over the next 12 months. So to get closer to 2.5% on the Fed funds. I think what's driving some of this negative sentiment in the market this month is what happens after that. So how much above neutral does the Fed have to take interest rates next year in order to cool inflation, and what happens with the economy after that? There are just a lot more possible paths for next year for the economy, and that's what should keep volatility elevated across asset classes. We do think there are some more negatives that have emerged over the next few months. So recession probabilities have risen. I think something 15 to 30% over the next 12, 24 months is perfectly reasonable. But that's still not the base case. The base case is still growth. So the way to square the circle of the negatives and positives is to say, let's bring risk down a bit closer to neutral, but let's not go too far and underweight risk. It's too early for that. Same by the sectors as well within the equity market. It's too early to start broadly overweighting defensives. Better just to start dipping the toe in a sector like healthcare, for example.